Well, hello everyone and welcome. My name is Elliot Gu. I'm co-founder of Capitalist Times Investment Research and Smart Bonds. Now, if you've been watching the mainstream financial media lately, you've probably heard a lot of bearish things about bonds. It's almost depressing, talking about a collapse in the bond market, surging yields, and asking questions about what's happening in the bond market. And I actually recorded a video and released it maybe a week or two ago regarding the spike we saw in Treasury yields during the height of the big sell-off in the stock market. And that's not what I want to talk about today. What I want to talk about today is actually a corner of the bond market that's actually doing really well in 2025. In particular, I'm going to give you the name, symbol, everything you need for a particular bond exchange traded fund we recommended in the Smart Bond service back on March 14th. And that particular ETF is up about 12% year to date. Now, of course, that compares very favorably. The broader US bond market is up a little bit in 2025, despite what you may have heard. And I'll tell you exactly how I measure that in just a minute. Long-term treasuries are down ever so slightly, about 0.2%. And of course, the stock market has been absolutely crushed, with the S&P 500 down about 12% year to date. So this ETF I'm going to tell you about, even though it has fairly small interest rate risk, is actually outperforming the S&P 500 year to date by almost 25 percentage points. So let's jump into it right now. First up, when you hear them talk about the bond market in the mainstream media, the financial media, on the internet, wherever, they're usually talking about US Treasuries, and in particular, US Treasury yields. The 10-year yield is a popular benchmark. And so here's a chart of that. Now, this is a chart of the 10-year US Treasury yield over the past 5 years, so going back to April 2020. And the yield and the price of bonds move in opposite directions, inversely. So when the yield is rising, that means the bond market's selling off, right? So what you can see here is that really since late 2022, the US bond market, on this basis anyway, has been in a trading range. And actually nothing's changed about that so far this year, again, despite what you may have heard. The lows for yields since late 2022, early 2023 have been in the 3.75% range on the 10-year. And the high was 5% set in late 2023. But we've actually come nowhere near retesting that 5% level since late 2023. We've gotten up to about 4.75 to 4.85% in the spring of 2024, and then again in the middle of January of 2025. So the US bond market on this basis, in terms of Treasury bond market, is in a sort of trading range. And as some of you may know, either because you're readers of Smart Bonds, or because you've listened to some of these videos that I've put up here on the website, know that I actually think that, especially at the top of this trading range, when yields are up around 4.4, 4.5% on the 10 years, actually a really good opportunity to buy bonds. Because if we do see a recession in the United States, or even just a slowdown in growth, like a soft landing, I actually think bonds could do quite well over the next 12 to 24 months. Similar to what they did in the late 1990s. But again, that's not really what I want to talk about today. I want to talk a little bit more about how we measure the bond market and this particular niche of the bond market that's doing really, really well so far this year. So take a look at this chart. This is year-to-date total return. So this is the price appreciation and distributions. Most of these ETFs, these bond ETFs, pay distributions on a monthly basis, not all, but most. And I've put 5 different ETFs up there. There's the BND, symbol is BND. That's the Vanguard Total US Bond Market ETF. So it's designed to track US Treasury bonds, but also US investment grade corporate bonds, US mortgage-backed securities, pretty much the entirety of the US bond market. The average maturity, or the bonds in the ETF, have to have more than 1 year remaining to maturity. The duration of this ETF is right around 7 years. So it's sort of an intermediate term US bond market ETF. it's a pretty good benchmark for how the bond market is performing, generally speaking. And again, that's the dark blue line on your chart. And as you can see here, through the close on Monday the 21st, it was up about 1.54% year to date, including distributions. So not great, but a heck of a lot better than the stock market, of course, down 12.83% year to date through the same close. Now, you'll also see there, I have included the SPY, which is the SPDR S&P 500 ETF that tracks the stock market. That's that green line there. As I said, that's about down 12.8% year to date. The orange line is another popular bond market benchmark that you probably heard a lot about, and you tend to hear a lot about in the financial media. That's the iShares 20-plus year Treasury bond ETF. So it tracks longer-term U.S. Treasury bonds. The duration on that is around 16 and a half years. So it's a longer duration, therefore more exposure to prevailing interest rates. That's the orange line. But again, despite what you may have heard, hasn't done very well very lately this month, but it's still only down, 0.2% year to date, which obviously is outperforming the stock market by a great deal. Now, here's what I really want to talk to you about today. There's that blue line, the light blue line, and the purple line, okay? And as you can see, that light blue line, and that tracks an ETF that I recommended in the Smart Bonds model portfolio to readers back on March 14th. So we've actually caught most of the gains in that ETF year to date. This is the one that I was talking about that's up 12.1% so far in 2025. Now this is the SPDR Bloomberg International Corporate Bond ETF, okay? Now this particular ETF tracks corporate bonds, so these are bonds issued by companies with investment grade credit ratings in currencies other than the US dollar, okay? Now it's important to understand that there are a couple things that are important to understand about this. One thing is that because it does not hedge its currency exposure, it does not hedge its exposure to the US dollar, I prefer that exposure right now because last year it was a good idea to buy and a lot of ETFs are like this. They buy foreign bonds, international bonds, but they also hedge their exposure to foreign currency because the dollar was relatively strong for many parts of last year. This year, though, the dollar has been quite weak, and this is a trend that I've been writing about, talking about a lot in Smart Bonds and in the other services we publish. And I'll talk a little bit more about that in a minute. But when the dollar is weak, you can benefit from that by buying an ETF like IBND that buys bonds priced in foreign currencies and does not hedge its exposure to those foreign currencies. In this case, the largest exposure is to the euro. This particular ETF also has exposure to the Canadian dollar, the yen, and a few other currencies, but the euro is by far the most important. Now, it's important to also understand that just because a company issues a bond in euros doesn't even necessarily mean that it's a European company. For example, some of the holdings in this ETF are American companies that issue bonds denominated in euros or yen or other currencies or Canadian dollars. Now, why would they do that? Well, think about one of the bigger issuers in this particular ETF is JP Morgan, the big US bank. Obviously, it's a global company, has operations in Europe, significant operations in Europe, and so it makes sense that the company would want to borrow in different currencies to support its businesses in different areas. It just makes sense. So it includes the majority of the companies that issue bonds that are in this portfolio, this ETF, are foreign companies, but there are a large number of American companies in the portfolio that are issuing bonds in currencies other than the US dollar. Now, as I said, this thing is up 12.1% so far in 2025, which is outperforming the S&P by about almost 25 percentage points so far on a year-to-date basis. Now, you'll also note that purple line there. This is another high yield. This is actually another foreign international ETF that we recommended on the same date, back on March 14th. We also, since subsequent to that in late March, recommended another international ETF, which tracks international government bonds that are inflation adjusted. So these are bonds that the principal of the bond adjusts due to prevailing measures of inflation in the country that issues these bonds. So a number of foreign countries issue those bonds. All of these ETFs, all three of the ETFs have done very well, especially since mid-March. That high yield global ETF that I just mentioned, the purple line on your chart right here, this is actually an ETF that buys bonds issued by companies with below investment grade credit ratings. So these are what we now call high yield bonds. Back in the day, we used to call them junk bonds. Now, the junk bond market in the US is the largest in the world, but other countries also have junk bond markets, both developed and emerging markets. And this particular ETF tracks developed market high yield bonds. So these are bonds issued by companies with below investment grade credit ratings in countries outside the US in currencies other than the US dollar. And that one is also up 10.3% year to date. And it's up particularly a lot since late March when we recommended it. Most of the gains this year have come since then. So while everybody's talking about, the mainstream media is on and on about weakness in the bond market, the fact is that there are plenty of large ETFs out there tracking international bond markets that are doing phenomenally well this year. In fact, you may have heard, because I think it's talked about a lot more, how well international stock markets have done this year, right? And how much they've outperformed the US stock market so far year to date in 2025. And the reality is that IBND ETF that I'm showing you right here on your screen has actually outperformed global stock markets as well. One of the most common ETFs you'll see for tracking global stock markets is the SPDR Euro Stoxx 50 ETF, and it's a fine ETF. The symbol is FEZ, F-E-Z. And that one is actually up 10.1% year to date, but the ETF tracking primarily European bond market is actually up more than that. It's up, as I said, it's up 12.1%, a whole 2 percentage points more than that FEZ ETF. So just because you want to jump on the global bandwagon, and it's been a great bandwagon so far in 2025, you don't necessarily have to buy just stocks. You can also benefit from a weaker dollar, stronger investment returns outside the US this year by buying global bonds. And as I'll show you here in a minute, this is really nothing new. Now, this brings me to a key point, which is that one of the key themes that I've been writing and talking about across literally all of our publications is the shift in the great cycle, what I call the great cycle. And I'll link a couple articles or an article that I recently published about that on Substack below this video. But the general idea is that over time, there have been multi-year cycles where the US stock market particularly has outperformed virtually all other stock markets around the world, okay? And in those same cycles, you usually have pretty weak returns from global stocks. You have relatively weak returns from commodities as well. And then there have been also multi-year cycles where US stocks have underperformed most other stock markets around the world. The US dollar is typically weak in those cycles, and commodities are generally strong. And so the general idea of it is that I believe that we've seen since 2020 a turn in the great cycle. And these cycles generally last 10 to 15 plus years. So I think this change in the cycle is going to carry well on into the coming decade, into the 2030s. And we're coming off a long period, 12, 13, 14 years, depending upon exactly how you measure it, where US stocks beat everything in the world. The S&P 500 was the best place in town, the best game in town. And the US dollar was generally strong over this period, coming out of the great financial crisis years back in 2007 to 2009. But if history is any guide, I believe we're entering, and commodities generally were pretty weak also over this time period, right? Gold peaked in 2011 in the prior cycle. Oil peaked in 2008, but sort of a second peak in 2014. But commodities were generally weak over this time period, pretty much regardless of what commodity markets you want to look at. But US assets beat everything. I believe we're now entering a period where the opposite is going to be true. Commodities are going to be strong, global stocks are going to be US stocks, and I believe then the dollar is going to be weaker. We're already seeing a lot of weakness in the dollar. Again, I wrote about that in the article I'll link below. But one of the beneficiaries of this is going to be the global bond market as well. Now let me show you that here on this next slide. Now I actually took this slide from a report, and it's a great report, and I don't even remember who gave it to me or where I got it. It's actually a Deutsche Bank report, and it's called Long-Term Asset Return Study, and it was published back in September of 2020. So it's kind of old, but what it is it shows you returns for equities and bonds and some commodities by decade in all sorts of countries around the world, literally going back to the 19th century. So if you're interested in longer term cycles, it's a gold mine, right? And one of the things I wanted to look at is, how in the last, as I said, we see these multi-year cycles. And many of you probably remember the mid and late 1990s. Maybe some of you are too young to remember that, but I can tell you back in the mid and late 1990s, similar to the last several years, nobody wanted to talk about anything but the US economy, the US stock market, and in particular the NASDAQ and technology and growth names here in the US. So that was all anybody wanted to talk about. I remember, gold was out of favor. Commodities were out of favor. Oil was out of favor. Nobody wanted to talk about that. When I first started studying commodity markets closely from a professional basis, 25 years ago, you could go to these conferences talking about oil or gold, and there were very few people there. It was one room, right? And of course, we saw the top for the US stock market in 2000. US stocks went nowhere between the late 90s, 1998, I believe, and 2012. So there was a period of like 14 years where the US stock market went nowhere. The annualized return was sort of like 1 and 1.5%. Now over this same time period, the dollar was generally weak, global stock markets outperformed US stock markets, and commodities came roaring back. Now by the peak of commodities, very few people wanted to talk about US tech and the US stock market. There was a boom in interest in international investing, emerging market investing, and commodity investing, energy, gold, uranium, you name it, right? And at the same time, that was actually the time when you wanted to rotate back into the US market. And that's kind of how it's worked throughout history. You have these great cycles. But what I want to show you on this slide is actually the return from bond markets, aggregate bond markets. This is government bonds, but also corporate bonds, high-grade corporate bonds, in a number of different countries over two separate periods. On the left-hand side, you have the period from 2000 to 2009. Now again, this was the period, the last cycle, great cycle, that we saw that's similar to what we're seeing right now. So a rotation away from US stocks from 2000 to 2009, a rotation out of the dollar weakening, commodities strong, right? So how did the US bond market fare over that decade? Well, it was up about 6.4% annualized. It's that light blue bar. The UK bond market, United Kingdom, was up about 6% annualized over this time period. But look at these international bond markets, and all these returns are quoted in terms of US dollar returns. So obviously, the bond market in Germany would have been euros at that time, but I'm translating these returns so it's all in US dollar terms, so we're comparing, apples to apples, not apples to oranges. So US bond market 6.4% annualized from 2000 to 2009. But look at the German bond market, 9.6% annualized, trounced the US bond market. Look at China, 9.6% annualized. Look at France, 9.7% annualized. You had 8.1% annualized from Korea, 7.9% annualized from China, and 7.8% annualized from India. So very strong returns from bond markets outside the United States. Now, let's go back even further to the 1970s, specifically the period from 1970 through the end of 1979, that's that decade, where the great cycle turned similar to the way it is now. Weaker dollar, strong commodities, and US stocks kind of underperformed. Now, here is a chart of annualized bond returns in US dollar terms, right, over that decade. For the US, 7.3% annualized. Okay? The UK, 6.1% annualized. And you had India, only 4.3% annualized. But look at these other markets out there. You had Korea, 21.4% annualized return in the 1970s. France, 9.6% annualized returns. You had Germany, which at that time was West Germany, 16.7% annualized. So my point is, look, if you're interested in international investing, if you're looking to get out of the way of the terrible sell-off and the terrible returns we've seen from US stocks so far year to date, international stocks are one option. I do like some international markets right now, but don't forget the bond market. There are some very strong returns with less volatility, less risk, right, in global bond markets right now, as well as much higher yields than are available in the stock market in most cases. So look at the bond market, look at some of these bond ETFs. One of the bond ETFs I like and recommended back in mid-March was IBND, which is the SPDR Bloomberg International Corporate Bond Fund, which provides you unhedged exposure to currencies other than the US dollar. And there, as I said, there are a few more. If you'd like to see exactly all of the names, all of the bond ETFs we recommend in the Smart Bonds model portfolio, I am offering free trials to the service for a limited time through the end of this month, April. I'll put the link you can click to check it out right now. These are extended trials. We don't normally offer an extended trial period like this for the service, but we are offering it through the end of this month. Again, if you're interested, click the link below. Never a better time to give the service a test drive. And again, don't be fooled by what you read about in the mainstream media or hear on financial television. The bond market is not doing bad. The US Treasury bond market is not doing great this year. But there are plenty of other places to hide and in fact produce positive returns, and in some cases, like IBND, produce positive returns far greater than global stock markets. So again, my name is Elliot Gu. Thanks for listening. I hope you found that useful, and I hope to greet some of you as trial members of the service here in just the next few minutes. Thanks again.